Hello. Hope everybody's doing well. I think it's time for a 4 to 5 minute educational video. And you might ask why. Well, the market was down 800 points yesterday, and so the volatility continues. And so I think it's important for us to just look at history, education, and making sure we're not making any mistakes. So we're going to start off with what is a crash? Stock market crash is a sudden, dramatic decline of stock prices across a significant cross-section of the stock market. Using annual market performance, we looked at 20% or greater drops and also 30% or greater drops. Since the history of the stock market, 20 to 29%, it's happened 3 times. 3 separate times it's been over 30 since 1926. And then this next slide, I think, says it all. So there's been 92 periods, 68 years it's been up, and that average return is 21.12, and 24 years it's been down, and that average is 13.61. So roughly 3 out of 4 years the market's up. And so when it's up, we want to make sure we get all those gains, and when it's down, we really want to make sure we don't make decisions that cause us to lock in those losses, which ultimately brings our long-term performance down. And that's a lot about what you need to focus on when the market's volatile like it is now, or there's even a crash. It feels like we need to do something when the right thing to do is nothing. So S&P performance since 1926, there's your 10.16%. And we've done the studies before where the average investor that's making the mistakes is bringing home around 4%. I don't want you to be one of those people. The problem: when the market's at an all-time high, there's fears of a pullback, or there's fears that this crash is going to last forever and we're going to lose it all and it's never going to come back. The funny part is, it's always come back, but every year it happens, or every time there's a little bit of a correction, it seems that this time is different. So let's look at that. Let's look at 1985 to 2017. Market's at an all-time high right here. This is when people start talking, there's fears, we should get out of the market. Well, here's another all-time high. There's got to be a correction, it's been a bull market, it's time to get out, something's going to happen. Well, this is an all-time high. Well, it might be time to get out of the market. So as you can see, the same old stories. These are all the all-time highs. And you could have missed out on all these returns. So we got to play the long-term game once again. Lots of stars, lots of all-time highs. I'm glad if you've been investing your money with me, you've stayed the course. And there's what that $100,000 would have grown to. All right, so if you're waiting for certainty, you'll probably never be in the market. There is no certainty. If you agree that the market is affected by news, which I would say yes it is, any type of news out there is definitely affecting the markets. And then if that's the case, do you think news is predictable? Do you think natural disasters are predictable? Do you think that fears and speculation of trade wars is predictable? It's not. So the markets are totally unpredictable. We can't try to time it. We got to academically expose ourselves to it to win in the long run. I get it. I hate volatility. I hate the ups and downs, but this is where we really make our money, is at times when the market's down and we're feeling those emotions, but we don't act on them and we do the right thing. One of the worst possible things an investor can do in a down market is panic and sell. This is where there's a massive, massive transfer of wealth. Most people know buy low and sell high, but they don't do it. In my experience, rebalancing is the hardest thing to do in investing. Just wanted to tell you a story. I was contacted by one of my clients who has an automatic investment each month. And that's dollar cost averaging, where if it's down, you're buying more, and if it's up, you're buying less. So it kind of forces you to buy more when it's low and buy less when it's high. And this particular investor wanted to stop his automatic investments until the market came back. So basically what he was telling me was he did not want to buy into the market when it's at a discount. He wanted to wait till it was more expensive so that he could buy into the market. And these are the type of things that make no sense, but it's because of the emotions that are causing us to make different decisions. It's real easy to buy into a diversified portfolio, but it's difficult to stick with it when we see things that are going on right now and we start to panic. And this is where I have to earn my money and talk you off the ledge and make sure that you look at academic numbers that are going to help you make decisions. If you're not prepared right now, it's going to be too late. The crash is never the problem. The crash is never the problem. It's investor behavior that is the problem. So my job here is to make sure that you do not allow your emotions to get the best of you, and that is how we're going to maintain that long-term performance of a portfolio. This year's been tough. It's been very tough. Stay the course. If you have any questions or you want to talk about an individual circumstance, please reach out. I'm always here. Other than that, have a great day.